Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Kim. Today, my friend and I will explain about past question on December 2017.
Okay, before we proceed, I would like to introduce our members, which are Nur Amalin Aisyah binti Muhammad Ajran, Nur Alia Samihah binti Afandi, Nur Farisha Ayu binti Muhammad Al-Sidi, Hana binti Hassan Halmi, and Muhammad Hakim bin Nazmin.
So, the first question is on 1st July 2015, Evergreen Berhad acquired a building at the cost of 2 million ringgit. The economic useful life of the building was estimated to be 50 years. Evergreen Berhad had been using the building as its staff training center. The fair value of the building on 1st July 2016 was 2,058,000. It is the policy of the company to measure its property, plant and equipment using revaluation model and investment property using fair value model. Accounting year end on 30 June. So, the first question is discuss the accounting treatment of the building for the year ended 30 June 2016 and 30 June 2017. For 30 June 2016, on 1st July 2015, the building is classified as MFRS 116 under Property, Plant and Equipment. The second one is the depreciation expense for the year is 40,000. We get the 40,000 by 2 million divided by 50 years. And the third one, on 30 June 2016, the carrying amount of the building is 1,960,000. We get that amount from 2 million minus 40,000. For 30 June 2017, the first one is on 1st July 2016, there is a surplus on revaluation of 98,000. We get that 98,000 from 2,058,000 minus 1,960,000. As the carrying amount 1,960,000 is lower than its fair value 2,058,000. The second one is therefore the carrying amount in the beginning of the year is 2,058,000. The depreciation expense for the year is 42,000. We get that 42,000 from 2,058,000 divided by 50 years minus 1 year. And the last one, on 30 June 2017, the carrying amount of the building is 2,016,000. We get that amount from 2,058,000 minus 42,000. Now, it's time for question 1b. Assuming on 1 July 2016, Evergreen Berhad had decided to lease out the building to tenants under operating lease. The fair value of the building on 30 June 2017 was 2,158,000. Discuss the accounting treatment of the building for the year ended 30 June 2007. So, the answer is the building is treated as investment property under FAR320 investment property on 1st July 2016 and is measured at the fair value of 2,158,000. Any difference between the building's carrying amount and its fair value is treated in the same way as a revaluation in accordance with MFRS 160. Hence, 198,000 surplus on revaluation of the owner-occupied building is credited to asset revaluation reserve. Under fair value model, no depreciation and impairment tax are to be provided for the building. Last one, the carrying amount on 30 June 2017 is 2,158,000. be more understandable, I have made a table for showing the accounting treatment. So, the cost of owner-occupied building as at 1 July 2016 is 2 million. And then we will left with accumulated depreciation, which is 2 million divided by 50 years, and we will get 40,000. So the carrying amount as at 31 June 2017 is 1,960,000. Fair value as at 1 July 2017 is 2,158,000. So surplus on revaluation as at 1 July 2017 is 198,000. And now it's time for journal entry. The first one is debit accumulated session of 40,000 and we credit PPE 14,000. The second one is we debit building with amount 198,000 and we credit asset revaluation reserve with 198,000. The last one, we debit investment properties with 2,158,000 and we credit building with 2,158,000. Thank you.
Assalamualaikum and hi. My name is Hana binti Aselmi. So I will present to you from this group assignment for question 2. So the question is, Vista Berhad bought an asset at a cost of 75,000 on 1st July 2016. On 30 June 2017, similar asset had been actively traded in the market at 85,000. So the cost to sale is 2,500. So the question is, assuming the asset is catered for its mean, explain the appropriate accounting treatment of the asset for the year ended 30 June 2017. So the answer is, on 1st July 2016, the cattle is recognized a biological asset according to FAR320 agriculture, as it is a living animal reared for its meat and engaged in cattle farming, which is the agriculture activity. So it's initially measured at the cost of 75,000. While at the end of reporting period of 30 June 2017, there was a gain in changes of fair value of biological asset amounted to 7,500, which is the cost minus with cost minus, which is the fair value minus with cost to sale and minus the cost, and the total will be minus with the cost. So the gain in changes you recognize as an income in statement of profit or loss. On 30 June 2017, the carrying amount of the biological asset shown in the soft P is 82,500. So the second one is prepare the journal entry. So as at 30 June 2017, debit biological asset amounting with 75,000 credit bank, and debit biological asset 7,500, which is to show the gain in changes in fair value with the same amount in statement of profit or loss, which is income. So the next one is question 2b. So the question is, assuming the asset is equipment used in research activity which has an estimated useful life of 5 years and the cost model is adopted. So it requires us to explain the appropriate accounting treatment as well. For 30 June 2017, the asset shall be recognized as an expense in statement of profit or loss because it does not meet the criteria recognition for PPE as per MFRS 116, which is the asset was used for research activity. As we know, PPE need to in supply of goods or services. Other than research activity. So that's an equipment amounted to 75,000 will be written off in statement of profit or loss. So the next one is prepare the journal entry. Debit research cost as per same amount, 75,000, and credit bank. So that's all from me. Thank you.
Is now Farisha Ayu binti Muhammad Rosidi, and I would like to discuss question 3. Question 3 is, Crescent Berhad acquired an asset on 1st July 2016 for 800,000. The useful life of the asset is estimated to be 50 years. Fair value of the asset given by the independent valuer on 30 June 2017 was 980,000. For a subsequent measurement, the company adopted the following model for its asset, which is investment property for fair value model, PPE for revaluation model, and intangible asset for cost using the cost model. So the first question is, discuss the accounting treatment of the asset for the year ended 30 June 2017, assuming the asset was a building rented out to Crescent Berhad subsidiary company. So, The answer is we must provide the accounting treatment for year ended 30 June 2017. We assume that the asset was a building that rented out to Crescent Berhad. So the answer will be, the building is classified as an investment property as per FAR320 investment property on 1st July 2016 because they acquired on the 1st July 2016, because the building is rented out to Crescent Berhad subsidiary company. The building is measured at the initial cost of 800,000. Since the company adopt a fair value model, so this one is the IP, investment property, so the company adopt the fair value model. To measure the investment property, there is no depreciation expenses provided. The carrying amount of the building is 980,000. Changes in fair value of the investment property will be recognized in profit or loss. So the gain on fair value, 180,000, which we will calculate like this, 980,000 minus 800,000 is credited as income for the year ended 30 June 2017. So the next question is, discuss the accounting treatment again of the asset for the year ended 30 June 2017. But this one, we assuming the asset was a building provided by Crescent Berhad as housing facility to its foreign worker. So this one is the PPE. So the answer would be the PPE we're using the revolution model. So the answer will be like this. On 1st July 2016, the company will be classified as PPE as per MFRS 116 property, plant and equipment, and the initial cost is 800,000. The company adopt a revolution model to measure the PPE. The company provide depreciation expenses. Because we using revolution model, so we must provide the depreciation expenses, which is 16,000, which is 800,000 divided by 50 years because the useful life is for 50 years for the building, and we written off under expense in SOPR. On 30 June 2017, the building was revalued at 980,000 and the amount will be recognized as carrying amount. The accumulated depreciation of 16,000 will be eliminated. There was a surplus on revaluation amounting 196,000, which we calculate as 980,000 minus by 800,000 minus again by 60,000. This is the accumulated depreciation of the year, and the company must debit the building account. So the question 3C is, assuming the asset above were a license and on 30 June 2017, its recoverable amount was 700,000. So we will calculate the impairment loss like this. First we must find the carrying amount, which is 800,000 minus by 800,000 divided by the useful life of the asset, which is 50 years. We got the 784,000, and we can calculate if we have the carrying amount, we can calculate the impairment loss. The impairment loss is when the carrying amount minus by recoverable amount. So we got the carrying amount for 784,000. We minus by 700,000 the recoverable amount, and we got the 84,000 ringgit. Okay, the journal entries on the impairment loss, which is debit impairment loss for 84,000 and credit license 84,000, because we already calculate the impairment loss for 84,000. That is why we got the journal entry like this: debit impairment loss and credit license for both 84,000.
Hi, my name is Nur Alia Samia Binti Afandi, and I will discuss about question number 4. On 1 July 2016, the plant, property and equipment ledger of Crimson Berhad showed the following balance. Plans at cost 12 million, accumulated depreciation 4.8 million. It is the company's policy to provide depreciation on plan at 10% per annum on yearly basis. The following information was made available during the year. A. On 1 October 2016, one of the plant compartment was replaced, but it was only to restore the plant to its previous condition. The replacement cost was Rm 65,000. B. On 30 June 2017, one of the major compartments of plant was replaced by the Crimson Berhad, which put the plant in a better operating condition and extend its useful life. Replacement cost was Rm 500,000. The old compartment was purchased on 1 July 2013 at the cost of Rm 350,000. Question 4a. Explain the accounting treatment for the transactions in A. Answers. The annual depreciation for the plant is Rm 1.2 million. On 1 October 2016, there is a replacement on one component of the plant costing Rm 65,000. Since the replacement is just only to restore the plant to its previous condition, the cost of the replacement will be written in the shopper as an expense. Next is question 4b. Prepare journal entries to record transaction in B. Answer. Debit plan new component 500,000. Credit cash 500,000. Debit accumulated depreciation 140,000. Debit shopper carrying amount of all component 210,000. Credit plan all component 350,000. Next, debit depreciation expenses 629,000. Credit accumulated depreciation 629,000. Here's some workings for the replacement of component in B. Cost 12 million minus accumulated depreciation 6 million, and we got carrying amount 6 million. Add cost of new component 500,000 minus carrying amount of old component 210,000, and we got carry amount for the plan is 6,290,000, and for the new depreciation expenses we just take 6,290,000 times with 10%, and we got 629,000 for the new expenses.
Assalamualaikum warahmatullahi wabarakatuh. Okay, my name is Nur Amalin Aisyah binti Mama Azran. Okay, last question is question 5. A property development company, Damai Berhad, had completed the development of 20 units of shop houses on 1st July 2015. Each unit cost at 750,000 ringgit Malaysia. On 30th June 2017, the market value of each unit was 1 million ringgit Malaysia. The policy of the company is to measure its investment property using the fair value model and property, plant and equipment or PPE using revaluation model. The financial year ends on 30th June each year. Okay, for question 5a, assuming that 20 units of shop houses are for sale in the ordinary course of business. On 30th June 2017, there were 3 units remain unsold. So the question is identify the MFRS used. The answer is MFRS 140 investment property. Okay, for question 5A2, explain the accounting treatment of the unsold units in accordance to the relevant MFRS. The answer is, okay, first, the unsold units of shophouses are classified as per MFRS 140 investment property. Second one is the unsold units are measured at initial cost of 2,250,000 ringgit Malaysia, where 750,000 ringgit times 3 units. Okay, the fair value of unsold units on 30th June 2017 is 3 million ringgit Malaysia, because 1 million of each shophouses times 3 units of shophouses. Okay, for the fourth one is changes in fair value of unsold units will be recognized in purple, because there is, number 5 is, because there is a gain on fair value of 750,000 ringgit, where is credited as income in the end of accounting period. Okay, why we got gain on fair value? It is because the fair value is more than or higher than that its initial cost. Okay, so we have to subtract from 3 million minus 2,250,000. Okay, for 5B, assuming that 17 units of shophouses are rented out and the other 3 units are occupied by Damai Berhad, each unit could be sold separately. Okay, the question is explain the accounting treatment for the shophouses for the year ended 30th June 2017. The answer is, first, as the property can be sold or leased out separately, 17 units of shophouses are classified as per MFRS 140 investment property because it will be rented out to the third party, and another 3 units occupied by Damai Berhad are classified as MFRS 116 property, plant and equipment because it is used by the owner for the business purpose. Second one is, we explain about the investment property first. Okay, for the 17 units of shophouses, which is investment property, the initial cost is 12,750,000 ringgit Malaysia, where 750,000 times 17 units. Okay, the fair value on 30th June 2017 is 17 million ringgit Malaysia, where 1 million times 17 units. So there is gain on fair value amounting to 4,250,000, where 17 million minus 12,750,000 is credited as income in SOPER at the end of the accounting period. This is because we got gain on fair value because the fair value is more than the initial cost. Okay, so the third one is the last one is we explain about the PPE. Okay, for the 3 units of occupied shophouses, which is PPE, the initial cost is 2,250,000 ringgit, where 750,000 ringgit times 3 units. Okay, the fair value on 30th June 2017 is 3 million ringgit Malaysia, where 1 million each times 3 units. Okay, there is a surplus on revaluation of 750 ringgit Malaysia, where 3 million minus 2,250,000 ringgit, that is credited to asset revaluation reserve or ARR. Okay, we got a surplus on revaluation because the fair value is more than the initial cost. Okay, so thank you for your attention and lending me your ears. Thank you. Assalamualaikum.